Good morning, traders. I'm Michael Sabo, Senior Commodities Broker here with RJO Futures on Friday, January 18th, bringing you some commentary here in the energy market. So let's get started here. What do we have going on? Well, we're still looking at the Feb oil here today, but keep in mind, Monday's a holiday, Martin Luther King. Markets will be a closed, small electronic session. Starting Tuesday, we'll start looking at that March oil. Right now, we've got Feb oil off about 10 cents, trading around 95.39. And let's talk for a minute here about yesterday. Impressive move yesterday, bit of a breakout. Crude prices kind of staying firmer there throughout the day. But certainly here now on the overnight coming in this morning, taking a little bit softer tone, coming off here just a little bit. We've got the Brent, we'll take a look at that here, which is the March contract now. Feb's already off the board. That's off about 21 cents, around 110.89. Nat gas a bit firmer here. We're up about 1 to 2 cents here, trading around 351.30. And the complex here just a bit weaker. The RBOB's around 276. That's off about 80 cents. And we've got the heat trading around about 303.05. That's actually up just a little bit right now. We're up about 93 cents there. So, what do we got kind of moving these markets here? Well, we've got China GDP that came out just fractionally better here last night. And we had something interesting developing here. The IEA is actually coming in line with their demand projections closer here to the EIA. So you want some clarification on that, give me a buzz. I'll explain that to you a little bit more. Two different agencies, one international, one domestic. And they're basically projecting here demand forecast here for 2013 to inch up here just slightly. Basically, they're kind of coming together here with their thought process here, the idea that we could see some increased Chinese demand. Nonetheless here, we've got to talk again about that supply side picture, and that's something I've mentioned in a lot of these other posts here. Taking a look at the DOE data that came out here earlier this week, you've got to keep this in mind here. Year over year stockpiles here, we're running here a positive 29 million barrels. Taking a look at the 5-year average, we're running a little over 36 million barrels here on the plus side. So we clearly here, our stockpiles do appear to be on the ample side here. Looking at the refinery capacity utilization, and I think that's important for traders to look at. Here's the reason why. Right now we're running here at about 87.9% versus year ago levels for this time period of around about 83.7%. So, refinery capacity utilization implies or has the potential to tell us here what kind of demand we could see. And if we're already running here close to the higher side, there's not much more these refineries can do here to help absorb that excess oil. And so if we start to see builds, that could continue to add to our stockpiles. In other words, what I'm getting at and what I'm saying, my opinion is this. You got to be looking at the short side of oil right now. I realize prices have been moving up, but take a look at those charts. We've seen a pretty impressive move, not much of a pullback here. So I think prices right now are on the higher side. I think as a trader, you should be thinking about looking at the short side, but you got to be careful because crude prices, as we know, they could get a little explosive. We've got some tensions going on in Algeria. Although that facility over there is nat gas related, we're certainly seeing, traders talk about, the spillover here into the oil market. So give me a call, shoot me an email. You want to get into some strategies here. We could talk about some risk management ideas here if you're interested in playing the short side or the long side. A lot of opportunity in that oil. So give me a call. And of course, remember that futures trading does involve a substantial amount of risk. May not be suitable for all traders. Good luck and good trading.